Look, I'm in this privileged position where I get to see a lot of property investors' decisions that they made, not only in the last couple of years, but quite often over a period of many, many years. And it's not until you actually get that opportunity to look backwards and see the decisions that the people make, to see where you could probably fine-tune and make some different choices along the way. So I've come up with some mistakes that I probably see that investors make all the time, which if you can get around these, would mean that you can make better decisions today moving forward. And the first one of those is the assumption that all property doubles in value every cycle. And if you just think about Melbourne, for example, it's done a little over 8% compounding growth since the 70s, which we got the data from the Valuer General, which you can kind of think, well, if I apply that to every property in Melbourne, chances are I'm going to buy a property that's going to double in 9 years. The rule of 72 into 8 means a 9-year doubling cycle. But unfortunately, you're not buying Melbourne. You're actually buying an individual property within a localised suburb, within a localised street. And I know that we're a big fan of location does 80% of the heavy lifting. However, within a certain suburb, there's variances. And you can get some really strong performing properties in that suburb. And then down the road, 2 streets away, in the corner in the shade, you can get another property in the same suburb that doesn't do as well. So this unshakable belief that people have that all properties will double in value is something that I see all the time. Often from seeing a seminar being presented where the stats are put up on the screen, and therefore people think, well, okay, all I've got to do is put my name on a title and time will do the rest of the work for me. So I see that as being the biggest mistake, bar none, where people think that all properties will double in value, because they won't. The second mistake I see is investors focusing on interest that they pay through interest rate rather than the interest that they save over the term of the loan. Because for me, I think that residential real estate investing is a game of finance. Because if you can get the finance side of things right, chances are the compounding, the leverage that comes from investing in property can be quite straightforward. But the amount of times that people become very price sensitive, seeing through the microscope rather than the telescope, about what interest rate am I paying, who can get me the best rate, for me is a moot point. It should ultimately be what is the best structure that I can get to build a portfolio of property. That's number one. And then number two, what's the best interest rate that I can get? Because quite often at face value, you might get a structure that looks like it's more expensive, but then when you count the cost over the term of the portfolio and the term of the loan, you're making heaps of savings, you're controlling your cash, and you're putting yourself in a very, very strong position when it comes to lending. The third one I see is not seeing property investing as a team sport. So for example, you're playing, the obvious examples, basketball, football, you are relying on your teammates to get the outcome that you're looking for. But quite often people see it more like a game of tennis or a game of golf when you're actually on your own. But if you actually think about that, even the world's best golfers, even the world's best tennis players, they still have a coach. They still have a caddy. They still have a team that helps them get the best out of their performance. So ultimately, not even those guys are actually an island. But when it comes to our own finances and our own property investing, quite often we want to huddle and stay in the corner and look after it ourselves, rather than bringing other professionals into the mix to help us get ultimately our outcome. So for me, property investing should be seen as a team sport. Yes, you may have to pay some fees to get some of these people onto your team, but let's look at the bigger picture, the bigger outcome and the goal that we're looking for, and reverse engineer how much money you'd actually save by bringing people onto your team rather than trying to go it alone and do it yourself. I guess in looking back at lots of portfolios, another mistake I see is people confusing activity with accomplishment. So by that I mean, imagine if I'm just sitting down all day, I'm in a rocking chair, and from the moment I wake up to the moment I go to sleep, I rock all day. Now, I'm actually doing something all day. I'm actually exerting some energy, and I'm actually not standing still, but I'm going absolutely nowhere. And I think that's quite often the case with property investors. In the absence of having some meaningful end goal or outcome, they just decide, I've just got to keep buying properties, I've just got to be in the market and doing stuff. And as I say, confusing activity with accomplishment. Whereas some of the plans that we put together means that people have their principal place of residence, and over the lifetime of a working period of 15 to 20 years, they might only buy 3 or 4 investment properties, one every 2 or 3 years, until they've actually got it, and then look to retire the debt. Game over, job is done. So it's important to understand that it's not about getting 7 properties in 7 minutes, 22 properties in 22 months, like you see on the front cover of the magazine. But more importantly, we're going to go, what do I actually want out of this? And then be in a position where we can reverse engineer what that looks like. And then just get on with getting on with life. Another mistake I see is people operating on gut feeling rather than facts. And it's amazing how many times I see someone come to me and say, I'm going to buy this type of property in this area because I just feel that it's going to go off. And having known the science that goes behind property investing, because we've got to remember we're buying an asset that's highly emotional, it's highly practical for most people. 70% live in it, 30% rent it or invest in it. So it's a very, very emotional asset. So I guess the idea that I've just got this good feeling about this area is not quite enough, because there actually are some facts. We need to look at incomes, we need to look at scarcity, we need to look at owner-occupier appeal, some things that I've talked about very, very regularly on these how-to sessions. But ultimately that sense of just doing something because they've got a feeling rather than actually putting some science or facts behind it. For me, because I get to see, again, the rear vision view mirror, look at that to see, okay, you had a gut feeling back then, it hasn't performed so well. So ultimately, that might not be the best way to invest in property. I remember the first time I went bungee jumping, I got up to the top of the stairs, it was about 70 metres up, and I was looking down, and it frightened the living daylights out of me. And I remember I had a bunch of mates down the bottom who were looking at me doing this jump, and I'm thinking, all I want to do is walk back down those stairs and pretend I'd never turned up. But ultimately I jumped and I got this amazing adrenaline rush, touched the water, got back up, my friends were going, yeah, that's awesome. So I remember that feeling, and it was addictive. And as soon as I finished the bungee jump, I wanted to go back upstairs and do another one, despite the fact I was so fearful before I'd done the first jump. I often worry about investors who are looking for that adrenaline feeling with property investing, because to be honest, it should be really straightforward and really boring and predictable. And I see it so often that people may be a little disillusioned with their job or what they're doing, and they're kind of looking for their kicks out of property investing, where they get seduced by the next best thing. They want to renovate, they want to develop, despite the fact that they've got no experience in these areas, and despite the fact that they're about to give up their weekend and probably not factor in an hourly rate for the things that they're doing. So I do worry when people want to get adrenaline out of property investing, because it should be very, very boring and very, very straightforward. And my last mistake that I often see people making is, just because you live in a house and because you understand the mechanics of 7 or 10 years ago you maybe have bought a house to live in, it doesn't necessarily mean that you know how to invest in property, because of all the 15,000 plus suburbs, the millions and millions of dwellings in this country. You've got to have the ability to determine what is investment stock, which is pretty much anything residential, versus investment grade, which is ultimately where you're going to get the performance for your property. So I guess that's just some lessons that I've learned personally myself, and also being in a position where daily I talk to property investors and portfolio builders all the time. So I get a really diverse range of looks at different portfolios to see the decisions that people have made. So the conclusion is very, very simple. Property investing is a process. It's not an event. So if you take some advice and take some of the things I just mentioned and see it as a team sport, and get a few people involved that you trust, who've got your best outcome in mind, ultimately property investing can be a really fruitful and rewarding experience for anyone who gives it a go.